All right, let's pull back the curtain on one of the most powerful and honestly, one of the most straightforward tools in all of finance. We're talking about a concept that just cuts right through all the accounting jargon and the media hype to show you the simple, hard truth about how a company is really doing. And it all comes down to its cash.
So we're going to start with a puzzle, a paradox that has tripped up even seasoned investors for decades. It's a financial mystery that happens way more often than you'd think, and once you get it, it changes how you look at companies forever.
I mean, just think about that for a second. How does that even happen? You see a company, its stock might be flying high, the headlines are all about record profits, and then, boom, seemingly out of nowhere, it files for bankruptcy. It makes no sense, right? It totally defies logic.
And here it is. This one sentence is the key. This is the secret that unlocks the entire mystery. You see, profit can be shaped and molded by different accounting rules and assumptions. But cash is absolute. It's either in the bank account or it isn't. It's a fact.
Okay, so if cash tells the real story, how do we actually follow it? How do we track the money? Well, lucky for us, every public company is required to publish a report that does exactly that.
You've probably heard of the big three financial statements, right? The balance sheet, the income statement. Well, this is the third one, and its job is beautifully simple. It follows the journey of every single dollar, where it came from and where it went. No opinions, just facts.
Now, to make this whole story super easy to follow, this statement is broken down into three main parts. Just think of them as three different camera angles, each one giving you a unique view of the company's financial movie. These three pieces tell you the whole story. First up, you've got operating activities. This is the company's heartbeat, the cash that comes in from its main day-to-day business. Next is investing activities, which shows you the game plan for the future. This is money being spent on big-ticket items, like new factories or technology. And hey, don't be alarmed if this number is negative. It often just means the company is betting big on its own growth. And finally, you have financing activities. This shows you where the funding is coming from. Is it taking out loans, or is it raising money from investors like us?
All right, let's circle back to our central mystery, that huge gap between what a company calls profit and the actual cash it has. We're about to pinpoint exactly why these two numbers can look so different.
This is the question, isn't it? The income statement spits out that big profit number we always hear about, the net income. But we've already established that's not the same as cash in the bank. So, what's the deal?
The entire explanation boils down to two words: accrual accounting. It's the standard way companies do their books, and it is the single biggest reason why profit and cash can tell two completely different stories.
Okay, here's how it works in the real world. Imagine a company makes a $1,000 sale today. The income statement gets to record that $1,000 in profit right away because the sale was made. It's based on the promise of payment. But what if the customer has 30 days to pay that invoice? The cash flow statement doesn't see a single penny until that cash physically hits the bank account a month later. And that timing difference, that's exactly how a so-called profitable company can literally run out of money.
So, okay, this is all interesting, but what's the bottom line? How do we actually use this information to spot a healthy company and avoid one that's secretly in trouble?
And let me tell you, as we look ahead to 2026, in this kind of shifting economy, understanding this is more crucial than ever. Right now, the smartest investors out there, they're not getting mesmerized by profit figures. They are laser-focused on one specific part of the cash flow statement.
Here's the number one thing to look for. Is the company generating positive cash from its core business operations? If that number is negative, it's a huge warning sign. It means the business is literally bleeding cash just to keep the lights on. And the ultimate red flag? It's when a company is covering up that operating loss by constantly taking on new loans or selling more stock. That's not a sustainable business. That's a leaky bucket someone keeps refilling from the outside. Eventually, the water runs out.
So we've gone through quite a bit. Let's boil this all down into a really simple but really powerful framework that you can use to analyze pretty much any company out there. It really comes down to this. The operating section tells you about the health of the business today. The investing section reveals its plans for tomorrow, and the financing section shows you its relationship with the bank and with its investors. Just remember that. Today, tomorrow at the bank. It's such a simple and powerful way to read the true story.
So there you have it. You now have the tool to look right past the flashy headlines and focus on what's real, on the facts. You can separate the financial opinions from the cold, hard cash reality. So the only question left is, which company's facts are you going to check first?